Hello, everyone. Welcome to the Under the Hood podcast with Stein Capital Management. I'm your host, Vincent Beleja. Today, we have Matt Goff from ARK Financial here in Austin. Matt is a registered investment advisor. He's the chief investment officer of ARK Financial. And he's someone that we've been working with for a few years. And we like to talk shop about investing, about strategies. He's one of our friends who really appreciates alternative investments. So we really like Matt. But he has a really interesting perspective on alts, on portfolio construction, on the current market. So we're just going to do a little bit of everything like we normally do under the hood, but really understanding how his practice works, what he emphasizes, and how he's running his business. So Matt, welcome to the podcast.
Thank you. Glad to be here.
No, great to have you. And again, great to work with you. Matt, I wanted to jump into just give a little bit of background about ARK, about your role there, and just a little bit of that story. So I'm just going to give it to you, and then I'll jump in and interrupt you at the best time.
Yeah. So ARK was born out of from a group of folks who, a long time ago, we all met at New York Life, and we're kind of doing got into the industry that way. And then what often happens is you discover the limitations of working in a model like that. And so a couple of guys broke off, formed ARK, and I followed them a few years later. So so ARK has been an independent since, I think, 2012 or so. And I joined them in 2017. So it's a little bit different. With ARK, it does have a traditional RIA, but we've kind of got three branches that three divisions, if you will, that we put together. So the main go-to-market strategy for ARK is we work with what we call first-generation business owners. So that is really our target market. We're looking for folks who have sort of taken the venture to start their own business. And typically what we find there is that they've once they've reached a certain level of success, meaning they have a pretty substantial amount of revenue, they're starting to take money home, starting to have some momentum and success and so forth, is that they're really good at running their, whatever it is they do operationally in their business, but have really never been exposed to some of the more sophisticated planning techniques or even some of the basic planning techniques have just never slowed down enough to get those things in place. And so that's why it's just a fantastic market, because we get to work with really dynamic people. I mean, working with entrepreneurs is like
it's good. It's a pain at the same time.
Yeah, it is. But they tend to be some of the most interesting, dynamic, driven people. So great market to work with. And we can come in and help them. We start looking at their cash flow. We look at their business entities. We look at their tax efficiency. We look at all sorts of stuff and just help them put all those things in place. So that's kind of our consulting piece. What we call it looks a lot like a fractional family office.
That's interesting.
But it's for a group of people that, frankly, when we introduce that concept, they may not have ever even heard of the concept of a family office, right?
Talk to me a little bit about that, because that could be new to some of our viewers. What does that look like to be a family office and a fractional family office, which is kind of the role that you guys are taking over?
So family office is like, traditionally think of like Rockefeller wealth and like big, old money wealth, right? I would say in today's world, we're talking about, to have your own full family office. It's kind of a minimum of a family that might have $100 million of assets, right?
Okay. Yep.
And it's enough money where their complexity, their portfolio, their investments, frankly, just paying their bills, paying their taxes, keeping track of all their financial assets and all the moving parts, legal entities, legal strategies, tax strategies, all that stuff becomes so complex that you essentially need a full-time staff.
It's like its own business then.
Its own business. So if I had $100 million, I might hire a staff and say, you guys deal with all that stuff. I might have an attorney, I might have a CPA, I might have investment professionals, and it's et cetera, right? That is a traditional family office. Michael Dell has a family office, right? But those same sets of problems exist for folks that might own a business that's kicking out, they may be bringing home $2, $3, $10 million a year of income. They might have a balance sheet that's anywhere from 10 to $100 million with a business asset on it. They have the same sets of complexity, but when you look at the cost of running a family office, you still need all those things. You still need somebody in your corner doing great tax planning,
Mhm.
investment planning, cash flow planning, all that kind of stuff. But you just don't necessarily want, you're not going to spend $1 million running a family office. So
Yeah.
that's kind of the idea of a fractional office. We have all those experts. We bring all that expertise to the table, either in through our office or through our network of other professionals that we work with. And we just make that model more accessible for the family and we do it in a way that's just more economical and try to deliver all the same advantages of having that staff just on on a fractional basis. So
Yeah. No, I mean, it makes a ton of sense. And I think that having the aspects of a full family office for business owners, it's going to make them a lot more efficient. Tell me a little bit about, so if you bring in a client, you bring in a business owner, what are some of the things you're looking at? And kind of in general, I know we don't want to talk about specific
yeah.
clients, but what are some of the changes that you might make or the things that you really want to know about those clients to where you can make significant changes in just their overall portfolio or just how they're structured?
Yeah, well, and this is this kind of goes back to this idea of really focusing on what I would say first generation entrepreneurs,
Mm,
because I mean, if you think about that profile, there really is no profile. That's everyone from a mechanic who's grown up to own 4 or 5 auto shops, right?
right.
To someone who's got the more who was an investment banker and came out and bought a couple of businesses on their own. So there's a very wide profile. But when we
Mm,
come in, oftentimes, again, from running your own business, it's like you focus so much on your product, your service, what you're bringing to the market, that you tend to neglect
that's the truth.
all your personal planning,
That's the
right?
truth. That's right.
And things like, so we'll come in and it'll be things like, I mean, just like first 6 months, entity structures, right?
Mm,
You're set up as a C, here's why you should be an S, right?
right.
We want to break these two pieces up. You need a management company and these structures underneath. We want to take your real estate assets and we want to pull them out of your business and put them in their own separate entity.
Mm,
Things like might sound fairly straightforward to you, right? But to the entrepreneurs we're working with, they didn't even know that was an option. Their CPA that they've been working with since the day they were making, they hung their shingle out. That CPA, may or may not have the sophistication to do that kind of planning, but they just lose sight of it. They're just doing the
yeah.
tax returns, right?
Well, that's what I've noticed, Steve, because I'm a first generation entrepreneur myself.
Yeah.
And the kind of that arc that I see for entrepreneurs is they find a skill set in the market that they can reproduce and turn into, we'll call it a business, but really it's a job,
Yeah.
right? And
Yeah.
so it's a job for a while. Then they have to learn the skills of running a business and kind of coming to scale there. And so that's its own really educational journey that takes a while. And then they're unless they're very intentional about it, right, kind of running the financial aspect of their entire life and the business included. I
Yeah.
mean, that's not something that they can just go take a course on
Yeah.
somewhere else. And so I think providing that expertise is huge. And I'm going to agree. I won't mention the CPA firms I've worked with, but a lot of times, especially recently, it seems like it's become about the tax return. It's here's all the information, get me this, okay, here's the return. And even though in the past I've been promised we're going to sit down, we're going to have a tax planning meeting, we're going to restructure entities, do all these things, I haven't really seen it. The interaction is around tax time, around extension time, and then filing time, and then we don't talk to each other again. And I know that there is a lot of value that can be unlocked there about really planning, but my experience has been is everyone's so busy
Yeah.
that it's just like, the
Yeah,
drive-by.
that's exactly right. So if you had the time and took 2 days to learn a little bit about tax strategy and planning, fill the gaps in what you may not know, and then looked back at your last 2 or 3 tax returns, you might come up with 4 or 5 ideas that could save you whatever $200,000 in taxes next year, or
Sure.
$1 million over the next 10 years. Like, oh, I didn't know I could do this. Let's change these. Our team, that's what they do. They know that. And to your point, the CPAs, it's just not, I mean, you think about the CPA's life, right? It's April, October, and they're crushed and they just don't have time. And in the way their financial model, their economic model, they're not always paid, not always paid on retainer where they're coming up with
Sure.
the strategic advice and so forth. So there's lots of issues as to why that happens. Certainly there are fantastic CPAs out there, but it's just kind of the way it happens. And if you're that, if you're Michael Dell, you're getting all the attention you need in
Mhm.
every entity and every structure, and your tax efficiency is A plus. If you're the guy that owns 4 auto shops and brings home a couple $1 million a year, the CPA that you grew up with is probably not giving you that service, and
Yeah.
you can't really go to BDO or you can't go to one of the big 5, right? I mean,
Right.
so we try to fill that gap. That is so besides entities, when our advisors come in, we call them family captains. It's just this term that we've come up with and that we use when they come in and they start to understand what's happening in a family's business. Almost always that first 6 months is we're focused on the tax efficiency and planning. That's where the low hanging fruit
Makes
is, and
sense.
that's David Bull, who is the founder, the remaining founder at ARK and the lead strategist in that area. I mean, he set out 10 years ago to become one of the leading experts in the, like he just saw that gap we just discussed. He saw it
Mhm.
over and over again and said, I'm going to fill that gap.
Mm.
And so he went out and literally tapped into as much expertise as he could, read everything he could, talked to all the leading experts, tax attorneys, CPAs, anyone he could pull knowledge from. He went out and did that, and continues to do that to this day. And so when those families come in, he's got his playbook, and essentially very quickly we can make a big difference in either their sort of current effective tax rate, or certainly their effective tax rate going forward. So that's that planning side. We start there, and then it's just the efficiency of running good cash flow. Taking money out of the business and diversifying it into other assets, or reinvesting it back in the business if that's the right strategy. All those kinds of things. We help them make those decisions. So
Yeah. No, I know that's very helpful.
Yeah.
And I know that after a while, taxes can become kind of your single biggest expense when you're running a business, whether it's your income tax or some payroll taxes, all the taxes that are involved. It is significant, and most business owners don't have time. I mean, they really most, I would say, 99% don't have time to create a tax efficient strategy. So it's a big value.
And I mean, again, it's something that you've probably encountered. The complexity of it is insane, right?
Yeah,
Like,
it really is.
I
It
mean,
really is.
I'll throw out this term 199A, which is this, it's some business owners under some circumstances have the ability to deduct, sort of 20% of their revenue. But if you just follow the threads on that strategy in all of the give and take, and when it applies, when it doesn't apply, over a certain number it applies, the complexity is insane, right? And so even if you had the inclination and the time to
Mm.
look into it, you would probably just go, forget it.
Yeah.
It's just so
Yeah.
complex. But we know it. We understand it. I don't personally. This is I'm not the tax strategist, but David knows it. His team knows it. So that's one part of ARK. That's the main go-to-market strategy. That's what we do. My piece, so we have an RIA as well. I'm the CIO. So for the most part, going forward, my job is to, when those clients tend to, or they're ready to start accumulating assets outside of their business, or if they exit, they sell their business and have a large lump sum to invest.
Sure.
That's kind of my role. I do the investment strategies for those same clients. I mentioned our 3 roles. So we have the RIA, we have the family office practice, and our third is kind of we're fairly expensive, right? I mean, we're not going to be the right choice for.
Well, maybe, I mean, you could say expensive,
Yeah.
but maybe if you provide a lot of value,
Oh yeah.
right, then, I don't know, so maybe you're very valuable in that. But I understand what you're saying, right? It's not inexpensive,
Yep.
but it can still be very valuable what you're providing.
Yeah, I mean, I'm just saying, if you were a startup business, or
Sure.
if you're in that phase of business, and we've all been there, where it's like you're not sure how you're going to pay all your bills,
I
much
got to
less,
stay in business,
yeah,
right?
right.
Yeah,
Then we're not for you. Um, you're just not going to be ready. But there are way more businesses like that, and business owners who are in that stage than there are that are past the point of stability, and just need the coaching that we offer. So we put together what we call an academy.
Hmm.
Right now, it's specifically designed and sort of contained to one industry group that we got associated with. We take all that tax planning, cash flow, efficiency, entity planning, risk management, all the stuff that we talk to families about, and just kind of put it into an online subscription course.
Hmm.
And that's been fantastically successful for us. My colleague Nick Warren kind of runs that program. He's the he does the content online, and then we've got a coach who also kind of plugs in. So that's been fantastic, because we can take this knowledge that these planning strategies and techniques and all the things that we've talked about, and just bring it to a broader audience, and they
Hmm.
don't have to sign up for they don't have to sort of make that higher financial commitment to
Sure.
get started. They can plug in, and that's just been um we figured there was a market there,
Yep.
but the adoption of that was faster than we expected. And so I feel like there's probably more there, and we'll probably continue to do that. So,
And we've talked about the academy, and I did really find that compelling, because I thought, sure, not everyone's ready for maybe the full fractional family office services that you offer. But where else are people getting that type of education, where if they are kind of doing it themselves for now, I mean, you're led by experts, and I just felt like it was a super valuable program, and and in some ways, if they're doing it right, you're almost getting them ready to turn into that family office client,
yeah,
right?
it's a feeder system
Mm,
for our family office services. It is. When we've had many, pretty good percentage, say 10 or 15% of those clients sort of graduate out. So think of it this way: if you're in the academy, we're going to show you what to do, but you do it yourself.
mm, yeah,
Here, Vince, here's what you should do with your entity structures. Go find an attorney and get that done. If you hire us, tell you what should be done, and then we do it for you,
good for you.
right?
Sure.
So that's the real difference. And so people will plug into the academy and then go, yeah, this, I don't have time for this, and I'm gonna make the stretch and have ARK do this work for
Right.
us. And then, I mean, I think you probably have other financial advisors and RAs, who listen to the show. And I would just say, and I point to myself as well, is that who do these families that don't that we are that are finding their way to our academy or other programs like that, who would they normally go to? Well, they normally go to their CPA. They almost always have a CPA.
Right.
They might have a financial advisor, right? And that's financial advisor like me. Well, trust me, I can give them some tax efficiency advice and structure and so forth, but nowhere near the depth
Sure.
that David and that team can provide. Well, as we talked about earlier, they're just the CPAs. Their economic structure is not there to do it. The financial advisors, I mean, we're typically more focused on investment management
Right.
and that
Yep.
kind of thing. I mean, not always. I mean, many advisors are really good at financial planning, but very few are sort of take that next level into the depth that we can provide for that entrepreneur, the business owner, and so forth. So anyway, this is this niche that ARK has found, and we'll that is really where we go to market. So so I've kind of been building an RIA specifically suited for that type of client. I also have, I've been in the business, since 2008.
Okay.
So I also have a book of like fantastic clients that were, more of a traditional book of business and RIAs, retirement planning, financial planning, all that kind of stuff. I still have that practice that I do as well. So I kind of have two roles. I take care of this book of business, these clients that I have, professionals, retirees, all that kind of stuff. And then I focus a lot on the asset allocation and building investment solutions for this clientele, these first generation entrepreneurs and so forth, which are, they have their own challenges when it comes to getting them to invest in something besides their own business.
For sure. For sure.
Yeah.
No, I know a lot of entrepreneurs, not all of us, but certainly I can be stubborn about what I do or how I do it or what I've been doing that works. But I think it's so helpful to have, and it's a consultant isn't the right word, but if I can have someone that I can call and talk to and say, this is what I'm thinking about doing. There's really not many people that I can call, because you're right. The CPA will say, well, here's the tax side of it, maybe some of the consequences, but someone who's looking at kind of the future consequences of the decision from the tax side, from the financial side, that's just a really big deal. I think that most entrepreneurs, successful entrepreneurs, don't have. I'm in a group called C12, and you have a lot of seasoned businesses there, and we have a lot of those questions that come up, and a lot of times those will be discussed, say in a whiteboard session or a roundtable session, and we're getting these different opinions. Well, if you've got this taxable situation here, we have this attorney here, and we might have this real estate guy here, and I'll talk about real estate, right, to some of those guys, but kind of a full solution where you're looking at all the financial aspects of buying a building, of buying a business, of selling a business, right? Of being a founder and having an exit, and how do we make that exit the most tax efficient, to handle it in the most tax efficient way. And those are big things for entrepreneurs, and we don't know the answers.
Those are big things. And then if you pinpoint each of those professionals that you might go to. By the way, we're very familiar with C12. Both David's a C12 guy. And,
great!
And we have a couple other folks on the team who participate in C12. But if you're that entrepreneur and you think about your advisors, right? You have your attorney who's answer to whatever question you're asking. Should I sell this building, buy this building? Should I expand my business? Should I, do this joint venture, whatever? They're going to look through the lens, really, of the legal risk lens, right? If you ask your CPA, they're going to look literally just through the lens of what's the impact on your taxes, right?
Yeah.
Generally speaking. Financial advisor, right? Someone like me, if it's, hey, should I, I just came across this great opportunity to put $1 million down and buy this property. And the source of that $1 million is coming out of my AUM. And I'm saying that facetiously, right?
Sure,
it's not my money, right? A lot of times, what's the answer going to be? No, Vince, you shouldn't do that. Like, my portfolio is going to outperform that asset.
Right.
Well, you'd say, well, my advisor is not like that. Trust me, it's, that's an agency problem that exists.
Sure.
Across the industry. So we're trying to remove those kinds of things. We get paid fees for these other services that we're providing, comprehensive fees. It doesn't matter one bit to me if somebody's pulling a large amount of money out of the portfolio that we manage for them to go buy some other asset. It doesn't impact us, right? We have to be able to give them an answer that is that the right move for you and your family and your the things that you want to achieve and all that kind of stuff. Not, well, I'm going to argue against it because I'd rather you keep the $1 million with me so that I collect those fees. We're trying to erase those types of issues, those agency issues that exist in the business.
Well, and they are real issues, right? Because if you have someone that's just making their fees and their revenue off of whatever managed money you have, they don't want to see any of it go out the door. Even if it could be a really good investment, like you're saying, that really provides for structure, stability, future opportunity for the family. They don't want to see that money go.
Again, it's That's a difficult problem to overcome because there's just human nature, right? And you have to be wise enough to understand kind of what motivates somebody, and then you just have to solve the issue of listen, we're making our income and our revenue for ARK this way, and we structure it in a way where we are agnostic to
Mm,
what those decisions are, and so that I think that's helpful. It's idealistic, but it's something that we're trying to achieve. I heard someone say recently, and this will probably resonate with you, is just if you're in a professional services industry or position, which we both are, you're serving someone.
true.
Who
That's
are you
true.
serving?
Yeah.
Right. And you always have to be able to look in the mirror and ask that, be able to answer that question satisfactorily. Right. And the answer is, the wrong answer is always, I'm just serving myself, because
Sure.
that's a path that is ultimately going to fail. So
That's right. That's right. But I do like how you in that sense you're asset agnostic. It's just what's the best
that's right.
strategy,
Yeah.
and then you really are well aligned.
Yeah, I mean, again, I mean, I'm sure you have seen this, I mean, I know you've seen this in your life. It's like, hey, as an asset allocator with access to stocks, bonds, and other alternative asset classes and so forth. I know what I can do with with that type of portfolio, and then there's the entrepreneurial. Hey, I've got the ability. I bring up auto shops because we work a lot with
Right.
auto. It's
You
sort of
mentioned
this
that, yeah.
niche that we've fallen into. So we have a good portion of our clients own or typically own multiple auto shops and all over the country. And so they'll come and say, look, the guy down the street, he's got the best location, in town,
Mhm.
and he's ready to retire, and he's offering this deal. Like I can, I think the property is worth $1 million. He's willing to sell it for $500,000 because
Hmm.
he's just desperate to get out of the business. Again, you have to have the ability to go, absolutely. Like, let me clear up the cash. Let's go take care of this right away.
Sure.
Right. You have to, but again, go back to those professionals. Unless you have a team that their objective is 100% to work for Vince's interest, the answer is, I'm not sure. You already have enough real estate. You already have enough, exposure to these shops. I think you need to diversify. I think you should buy some other thing that will take care of for you. That's where, it sounds like I'm exaggerating that, but it happens all the time. It happens all the time.
I
Right.
believe it.
And the reality is the best investment ideas they certainly don't always come out of my office. They very often come out of the entrepreneurs and the opportunities they trip across just being in their community and the people they meet and all that kind of stuff. So that's why we love working with entrepreneurs, and so we always kind of encourage that, right? So
Oh, I like that. And that's one thing we talked about before was just the ideas and those investments that you see because of your exposure to entrepreneurs and people in the business community. And
yeah,
and then you aren't kind of getting that second or third or fourth or 10th level of that investment. You're getting kind of that, boots on the ground and the actual, opportunity
yeah,
and when it's fresh,
yeah.
which is a big deal on the investing side.
It is a big deal, and it's just an interesting place to be. It's you feel like you're sort of part of the the community that you live in, and part of progress of that community, and the capitalist ventures all around you that are making life better for your community.
Sure.
So
I like it. Matt, we talked a little bit about a second ago. You're doing asset allocation for ARK, and then you're also managing your own book
mhm.
besides that, but
Yep.
obviously doing asset allocation for those clients as well. Talk to me a little bit about your role there at ARK. What are the things that you're looking for, or maybe the things you're looking at? Guide me, on the journey of an asset allocator, especially in today's market. What are the things that are most important to you right now?
For simplicity's sake, let's just say this: the clientele are either in a kind of an accumulation phase. They're building wealth,
Mm-hmm.
right? Or they have accumulated wealth, and they're either moving towards, we want this portfolio now to generate income to
Sure.
replace. I'm selling the business. I'm not pulling money from the business anymore. I need my portfolio to pay for my lifestyle. Or they're a traditional retiree rolling over a 401k, or leaving their professional practice, whatever it is,
Sure.
that kind of thing. So I mean, we definitely start with a very much of a planning orientation, but in general, um I let's just take the accumulation solution, where someone is, they've got a good job, or their business is producing cash flow, and they've decided to start to build allocation in the future, right? Or to allocate some of their cash flow towards building a portfolio,
Sure.
right? So that's very much a growth orientation. So we will just say, I mean, my approach there, um, again, this is a little bit of a simplification, but let's just say the traditional RIA approach or wirehouse approach is, I'm going to give Vincent a test on his risk assessment.
Mm-hmm.
And
I've taken that before. Given those before.
Yeah, and depending on how you answer that day and how you're feeling, I'm going to give you a 60-40 or an 80-20. We kind of look at things differently. I just started like really peeling back the layers of this, and I'm saying, you know what? If you have a 20, 30, 40-year time horizon, even a 15-year time horizon, you don't need 30 or 40% of your assets in an asset class that is not, that is not going to give you more than 1 or 2% above the risk-free rate, right?
Mm-hmm.
What you need is enough hardcore, very detailed planning to say how much cash or how much liquidity, short-term safety, does Vince need now? Maybe it's a couple $100,000, maybe it's $1 million, depending on what's ahead of you and your business
Sure.
needs and your, all that kind of stuff. How much do you need for kind of risk management, flexibility if there's a surprise? And really the rest above that, we should be in productive assets,
Mm.
right? So it's not, hey, Vince, we're going to give you a 60-40 because of the way you answered this question. It's, we're going to make sure that based on everything we know about your cash flow, your cash needs, and all that kind of stuff we described, that, for some people, that's 10%.
Yeah.
Even if they tell me that they don't like risk, that's okay. We can still build a portfolio that has stability and liquidity and all that kind of stuff. But we don't have to put all of it in, a short-term bond fund, right? I mean, we can build a much better portfolio for the accumulators.
That's a lot more satisfying answer, right? Because I always thought it was crazy that just looking at a risk profile of how I feel, but not really looking at my situation and what my plans for the future are in constructing a portfolio. So I just want to say that makes a lot more sense to me.
It's that, I think it became that way in the industry. It's the least common denominator. I can ask you 10 questions and like, hey, Vince, how did you feel in 2008 when your portfolio dropped by 35%? You're like, it made me sick. Well, then you need a conservative portfolio. Like, well, not really. When instead I could say, I'll just give you an example. You probably know people like this. You may be like this, but there are people where they'll come to me and they'll have, I don't know, let's just pick a number, $5 million of liquid assets and very conservatively invested. And they're spending whatever, $100,000 a year. And so I'll just show them like, okay, like if we just do nothing, you've got 50 years. And we start to build from there. And I'll just show them like, what if we add 500, you're spending $100,000 a year. What if we add 500 or $1 million in relatively safe assets? You've got 5 to 10 years of safe assets set aside, something like short-term bonds or, treasuries, whatever, that kind of thing. And the rest, let's diversify into a set of assets. Now, I'm not saying stocks, right?
Right.
Because that's the default. People are like, oh, let's put, in that case, that would be if I put $1 million of that client, they're only spending $100,000 a year. They literally have 10 years. Where if everything else has a terrible 2008 kind of meltdown, they have 10 years before they even have to think about the recovery of that other portfolio. So it's just a different approach.
Yeah.
And especially for the accumulators. Now, again, if that same person is spending $100,000 a year and they come to me and they only have a $500,000 portfolio, we've got a different story. Now we're going to be almost 100%, on the safer side, right?
Mm-hmm.
So we take a planning approach to the asset allocation. Same thing on the other side. If they sell their business, again, we have these business owners that have built a lifestyle they're comfortable with. They may spend $200,000, $300,000 a year, and they're very comfortable with that lifestyle.
Sure.
They sell their business for $20 million, $30 million. They're not going to suddenly start spending $2 million a year just because they can.
Right.
They just don't. They just don't do that. Right.
Yeah, and I would think that they don't even they're so not used to even knowing what to do, because as a business owner they may have that net worth, they may have that on their personal financial statement, but they don't have that in cash or stock that can be converted. So all of a sudden it's like, what do we do here?
Right.
That's and even though we've got this lump sum, this big pile of money, right, $20-30 million from the sale of the asset. How will that last for us? Will that last for our kids and the grandkids? And I mean that's a big responsibility.
Yeah.
And I have a few friends that have done well. They haven't exited yet, but they've got their eye on that exit. And I've kind of had that same question. It's like, what are you going to do with yourself? What are you going to do with your time? And then what are you going to do with the money?
Yeah.
So
all right. So that we always start with the planning, and again, it's not that we're not taking into consideration their risk tolerance. We all, you have to, right? But we're approaching it in a different way. We're approaching it from a planning perspective, and we educate the client along the way. We're not in a hurry. If it takes the client 3 months to get there, it'll take them 3 months to get there until they understand why we want to do things the way we want to do. And then now the next thing is, and same approach again on the business owner that's exited, or the retiree that's pulling their 401k from Dell or IBM or whatever. So the next thing is, okay, well, what are these assets that you're building out? This was the next thing that I found over the years is inadequate. And this is kind of, we met probably in 2018 or something like that when I first came across Stallion. And at the time, what I was looking for was, I sat down and I'm like, okay, we got these 60-40 traditional portfolios, or 80-20 or something along those lines. And let's just take the 40%. So 2018, 2019, the 40% of the portfolio was generally held in some form of fixed income, publicly traded fixed income bonds, right? Government, corporate bonds, maybe high yield, that kind of stuff. And I'm looking at these portfolios, or the options that we have there in 2018. I'm seeing a yield of 1, maybe 1.5, right? And then you go, I mean, if you kind of understand bond math, you go, okay, well, rates are floating at the time or whatever, around 2 or something. And if we normalize rates, if we go back to 5% rates, not only are we suffering with a yield below the inflation rates, we're actually negative. 40% of our portfolio is actually not earning anything. It's actually losing money. And if interest rates normalize, then we're actually going to potentially lose money exactly in the bucket of money that we think is safe.
That's right. I mean, those safe assets are going to lose a lot of value, like you're saying. If we have a situation like we have now, where you've got 5% risk-free rate,
So the safe asset in the world that the vast majority of folks planning for retirement, and the vast majority of financial advisors, sure, there are plenty of great advisors out there who figured this out and did something different. But I'm just looking at it going, this cannot possibly be the right solution. So I go out and start saying there's got to be alternatives. Well, a lot of people just went to higher risk. They're like, well, forget it. I can't be 60-40. I'm going to be 80-20. I'm going to pour more money into stocks, right?
Yep.
Well, maybe that's the right choice in some cases, but a lot of cases that's not the right choice. And so we went out and I started to look for solutions. I find Stallion and other what are sort of broadly described as alternatives, and goes, man, wait a second. I've got a secured asset that's positive, above the inflation rate. So I'm positive yield, secured by, real assets, diversified, all of those things that you might look for and go, in the traditional financial advisor world or in the regulated world of wirehouses and so forth, they like, no. It was not publicly traded.
Right. It's a little too scary, a little
It's too
dangerous.
scary. And I'm going, wait
We've heard that
second.
before.
Yeah. And so that was just to really open my eyes. So I'm like, okay, real estate, right? It was like, okay, I get why real estate's a great asset class, but I'm looking at the sort of the traditional access to real estate for financial advisors is the publicly traded options. I'm like, what I know about real estate investors are they're getting better returns without the crazy volatility that you're seeing in REITs, right? So let's go look for that.
Sure.
Right?
Yeah, makes a lot of sense.
And then you just start to find, private equity, private credit, all of those types of alternative asset classes. You start to find great options out there. So this is 2017, 18, 19, starting to build out portfolios with a lot more of those. Fast forward to 2023, almost 2024, more choices.
A lot of choices, yeah.
More access, lower minimums, in a lot of cases, better liquidity, better risk management, better transparency. All of these things have improved in these private asset classes. So today, I would say if a substantial, let's just say a portfolio over $1 million and not trapped inside a 401k. Right?
Sure.
So if you have $1 million or more of a liquid portfolio, you should definitely be utilizing some of these asset classes that we've touched on, right? And if you don't understand them, you should understand them, because if you were in my chair, I don't think you're doing your fiduciary responsibility if you're limiting your clients to only publicly traded stocks, bonds, ETFs, mutual funds.
Sure.
And if you are an investor yourself, you're missing on the opportunity to improve either the performance, to improve either the return on your portfolio or to get an equal return with less volatility and less risk.
Less risk. I appreciate you saying that, because so many times what we see with a lot of advisors is there is kind of the rote, either 60-40, 80-20, these are the options that we have, everything is public. And I've always felt like part of the reason we got that I got into the business was being able to create our own investments with our own risk profiles, because not that there aren't great investments that are out there that are publicly traded, but they just weren't as interesting to me, or I wanted to do a deep dive. And I feel like so many advisors or asset allocators, it's like they're looking at the same menu because they don't want to look off the menu and really investigate. And probably because they are worried about risk and things like that. But there's a lot of good business that's being done, a lot of great investments that people are enjoying, and they aren't on the public menu, but that doesn't mean that they don't perform really well, control risk really well, and just have a great profile for investors.
Yeah. So the whole infrastructure available to most investors, the access to alternatives, which can be lots of things, right? The classics are, just private real estate, private credit, private equity and venture capital. The whole infrastructure is there are more choices, better run, all that kind of stuff. That is opening up a lot, and at a time when there are with the baby boomer retirement, where lots of assets will be reallocated and invested in different ways to support the baby boomer retirement. So, um, as an investor, you should be looking for that,
Mm,
right? If you've got money to invest and everything you have, everything you own has a publicly traded ticker symbol attached to it, you should probably ask why.
mm.
And if you're an allocator and you haven't investigated, it's time to investigate, because you're just going to see it adopted. And I mean, people are coming out of the woodwork now with just better products, better ways to get into those asset classes. So it's an exciting time. So
It is a neat time because I do feel like a lot of the investments that were available only for people with very sizable portfolios
mhm.
are now opening up to, it's certainly they have to be accredited investors, but they can just see a lot more. They can create better diversification, get away from the high correlation to the stock market and other assets. And I do feel like it's a great time to be an investor right now.
Yeah, yeah.
That's good.
So yeah, so I mean I think that's what I'm sort of most excited about. I'm inside. I'm trying to like think of ways to communicate this, because there's you and I can talk about it and come to a pretty quick understanding of what I'm talking about, but there's a lot of education that needs to happen, and you want the clients to be fully educated to understand. Okay, look, you're 30% of your portfolio is not immediately liquid. We might have to wait a quarter. We might have to wait 5 years to liquidate this particular holding.
Right.
They need to understand those kinds of things. But once they do, and they understand the trade-offs, and like, okay, it's okay if you've got a couple $1 million and you're spending a couple $100,000 a year, it's okay for you to have 30% of your portfolio not immediately liquid.
Makes
We're
a lot of sense.
okay,
Yeah.
right? So,
Yeah.
but they have to be educated on that. So
Well, but I like what you're talking about when you're structuring something is that immediate money is there, and there's a good amount of it.
yeah,
It's still earning some good income that's there.
yeah,
But if you have that,
yeah,
I mean, do you need to worry past, like you're saying, 10 years? It's okay to have, and that's one of the issues that we come up with sometimes with our clients because we have an 18-month commitment period. It's what if I need that within 18 months? We'll say, well, you should structure your portfolios such that
right,
you have cash somewhere else. This is more of an illiquid asset, and it is important to understand that. But I like what you're saying there is you don't have to have all of your cash available all of the time. I mean, I have some real estate holdings myself, and those aren't liquid assets, but they're some of my best performing
right,
assets from a return and from a tax standpoint
right,
over time.
right.
And I don't want to liquidate those assets. In fact, I mean, not want to liquidate those assets for a really long
Right.
time, right? Because it's a great store of value and a great performer.
Yeah.
So that makes a lot of sense.
Yeah.
What are the other things, if you wouldn't mind sharing, that if someone is looking to look for a new advisor or new entity to work with, maybe just help them navigate just a little bit about the things that you might look for someone that's really competent, that's going to do a great job with their capital.
Um, I mean, in our work, I do a lot of due diligence,
Mm,
right? So I'm often on the other side of trying to gauge whether to, so somebody is bringing an investment idea, a fund, or one of these private alternatives, and I've got to sort of gauge this the integrity of not only the deal, but are these the kind of people that we want to work with and engage with and all that kind of stuff. So I've been on that side of the equation, and spent a long time trying to like whittle down a few things that make the decision easy. If someone said, look, I'm looking for an advisor, but like let's say it was a family member that said, I don't want to work with you, it's too close, like,
sure.
who am I going to go look for? I think pretty much if you go into your community and you find someone that has tenure, um, I'll just throw out a number, say 10 years or more, right? Um, they have, and if they have if they've got a business and they're parked in a community, and if they've got 10 years of tenure and they've got a book of client business and they're willing to let you talk to some of those clients, that's a really, really good start,
Mm,
because this is a business that, I mean, when I take on a client, the intention is literally relationship for life.
Forever. Yeah.
Right?
Yeah.
So if I'm a sleazeball, that's not gonna work.
Sure.
Right? I got to replace that client every time they leave. So someone who's been in business for a while, how long have you been in business?
17 years.
17 years. If you were not treating your clients and your investors well, you would have had to move, right?
True.
You
Yeah.
wouldn't still be in Austin, right? So that's a thing. If somebody is new to a large organization, and I say this, I started at New York Life, right? Well, I can
Right.
tell you, New York Life hires some fantastic, great
I
high
know
integrity
a lot
people,
of great
right?
New York Life people. Sure.
And they'll hire someone who does not have the best intentions. They won't make it, right? But if you happen to run into someone who's there for a year and you're on their way out and they're desperate, that is not a good place to be. Someone who's desperate for your money is not a good place to start. So just look for tenure, stability. Get client feedback on can I talk to a couple of your clients? Generally, if someone has introduced you to this person, you probably know a couple of the families around you who have worked with that advisor and can speak to his or her integrity and success and all that kind of stuff. So that's a big thing. And the other is you really do need to dive into this. We just talked about this agency issue, right? So, for example, we've got we do have an AUM fee, right, for our clients, and we start at 1%, and then it drops. Like, so the first $1 million is 1%, and then there's a graduated schedule that drops, right? And someone will ask me, like, okay, here's my set of circumstances. How do you get paid? And I'll literally just tell them, okay, well, if off the back of the napkin, you're going to be paying about $15,000 a year on your $1.8 million.
Right.
So then the next question is, what do I get for that money? That's a lot of money, right? That's like,
Sure.
I'm paying you.
It's a good check.
I'm maybe paying you more than I'm paying in my mortgage or whatever. That's a lot of money. What am I
Sure.
paying for? And that's where you really have to kind of understand. So, part of it is asset allocation, investment management. That's a piece of it, but really most of that value, because I can, if you just did the 60-40 or the 80-20 portfolio with index funds, you're going to be okay, right? You're going to miss out on this thing and that thing, but you're going to be okay. You're not going to necessarily fail.
Right.
So if you're going to pay someone a substantial amount of money, what are you going to get? Well, that's the planning, right? Where I come in and go, look, you have, your 1.5 million is spread across these 3 or 4 accounts, and in this asset and that asset, if we do it this way, literally sometimes we can just improve their tax circumstances, change the way which accounts they pull money from. We can any number of planning techniques we can use that will pay for that fee for 4 years, like with one move, right?
I was just thinking, you could make up that one fee from some tax structuring very quickly.
Yeah. So again, look, this is a profession. The work is hard. It's when things are going great, clients call you and they say thank you, and when things are going not so great, you take a lot of abuse, right?
Sure you do.
And so people deserve to be paid for this, but they don't deserve to be paid if they're just putting you in some rote portfolio and calling you once a year and asking, do you have any more money to put into here? You should very easily be able to justify, we're charging about $15,000 in fees. Here's the planning advice we gave you, and here's where that value is being returned. When you have that discussion with someone, if there is any hesitancy in how they answer that question, if there's any lack of transparency, that should be a flag. So
I like that.
Yeah.
I like that. When we're working with our clients, it's the same way. It's if people aren't excited to work with us and they understand our methodologies, then it's just not a good fit.
Yeah.
I think people have to want to move forward and feel excited about it, and then if they have a good experience, they'll let their friends know about it. And that's a great way to grow your practice. Great way to grow our practice as well. Yeah. That's what we prefer. Oh, let me shift gears a little bit. It's been a really interesting 2023 and kind of 2022 before that, and really it kind of feels like maybe the world hasn't really been completely normal financially, maybe even since maybe 2019.
Agreed. Yeah.
What are the things that you're looking at, maybe the things you're concerned about or the things you're planning for over the next 6 to 12 months, knowing that this is an election year that's coming up, we're in a very different interest rate environment than we've been in for quite some time, and asset pricing is difficult right now. It feels like almost kind of across the board. I'd love to just get some of the thoughts that you have that maybe you're advising for your clients or the larger organization. Just what are you looking at right now?
I think the story by far, hands down, is interest rates,
Mm.
so we, for those of you in the business, this is a very familiar story, but maybe not. The sort of extremity of the last couple of years movement in interest rates may not be as obvious to folks who don't do this on an everyday basis, but interest rates are fundamental to all asset prices,
Mm.
and they drive business activity and credit, and how much banks are lending out, and all this kind of stuff. And the we have certainly we are you're old enough to remember that 5% interest rates, 7% mortgage rates.
Yeah.
These are high, but these are not abnormal. These are not unheard of,
Sure.
unprecedented.
Those are very normal rates for a
Right.
very long time.
Right.
Yeah.
The abnormal was great financial crisis to, basically 2022. Like,
Yeah.
that was the abnormal environment. And it wasn't a gradual return from effectively 0% rates post COVID to kind of save the economy to normalized 5%, 5-ish% rates on 10-year treasuries. That normalization happened in 18 months, something like that.
Very
Yeah.
short period of time.
That's what's unprecedented.
Mm.
So it could go on and on about the ripple effect of that drastic of an interest rate hike in that short of a time. But let's just take the business owner who has an SBA loan
Mm.
to whatever to finance the expansion of their business. They took that loan out in 2021, or let's say 2018 or something like that. They took it out at 4 or 5%,
Mhm.
and it's going to reprice. It's going that loan is going to reset at 8 or 9, right?
Yeah, it is.
And not only is it going to reset at 8 or 9, so if you're looking at your cash flow, suddenly you're going to be spending a whole lot more money on servicing debt. Not only that, the bank may come back and say, yeah, but we're also going to require you to put another 20% down on this.
Mm.
We're going to restructure this loan. We want more.
It's a hard conversation.
Yeah, and so that hasn't happened fully yet, right? And I'm not here to make any doomsday predictions, because I don't really have a feel for how that plays out. Credit people seem to be very creative about how to sort of get around those
Mhm.
things. But there will be some casualties there. There'll be a lot of casualties there. So the point is, in my mind, in my professional career, that sort of I got out of college, or I got out of my business school and started working in '96 till today. There's sort of two events. One was the Great Financial Crisis, which was a completely different set of circumstances. This interest rate hike is equally impactful, equally has a broader and maybe longer lasting impact than sort of the acute pain that was caused with the Great Financial Crisis.
Interesting. Yeah.
So, but everything like that, those two events, Great Financial Crisis, this interest rate hiking environment, it creates pain and also creates a lot of opportunity. So this
Yeah.
is where we are today, right? Stocks, equities. Let's just say equities. I mean, generally, business ownership is the business ownership, and let's say real estate ownership. Those are two paths to building wealth over time. that the key there is just not to if you just don't pay an extremely overvalued price for something, and if you hold it long enough, a good, fundamentally good business will do fine.
Do all right. Yeah.
So I'm not really concerned about stocks right now. I think, are they overvalued? Maybe a little bit, but not at a level that it's extreme,
And
right?
not something that's going to hurt you.
Yeah.
Jim.
Commercial real estate. Okay, there's a pocket that's troubled, right? And that's not everywhere, but that's certainly certain assets, certain cities, et cetera. Like there's pain ahead in that sector.
Right.
But
especially as rates reset.
Yeah. But what does it do for the saver or the retiree? So that maybe some baby boomers retired in 2019 or 2020 into that zero interest rate environment, and they had to be heavily into stocks to get anything out of their portfolio. Totally different regime now. I mean, we've got, risk-free rates at 5, and if you go out a little bit on the yield curve or on the credit curve, right, you get 7-8%.
Yeah, it's different times than we've had in a while.
Public equity, long-term returns are 9-ish%. If I can get 8 with contractual return of my money,
pretty good.
This is a good time. Right? So that's the opportunity. The other thing is, we talked about like these assets that are getting repriced either because they're heavily. So think about the private equity world, right? I come in, I borrow a ton of money, buy a business, improve the business, and try to turn around and sell it 5 years down the road. That's
the model.
Yeah, that's the model. Well, if I borrowed all that money at 3, 4, right?
Yeah.
And I got to reprice that debt, I'm in trouble,
Big
right?
trouble.
So this is, so now you've got potentially high quality assets. I mean, the company itself, those businesses may be great businesses, or a portfolio of those businesses may be great businesses, but you've got this, mismatch, and you've got this, this sort of wall of interest rate hikes coming, or of interest servicing debt, coming. And so now you've got people trying to unload those assets, so they're selling those assets at a discount.
Right. It's a bad time to sell. Right
yeah,
now,
exactly. So these the normalized environment's going to create some pain in some sectors, but for clients who are wanting to hold cash, retire, want safe assets, we're not only are we generating a good rate of return, it's a rate of return above the inflation rate. And we haven't had that in a long time.
Sure.
That's a great place to be. So it's a mixed bag. And then just generally, so that's sort of the near term, right? Generally though, if you just think about technology and where things are going with just American industry in general, I feel like it's 1996 and the internet, right? AI and robotics and
big changes,
and genetics, and I mean all these like this we cannot lose sight. We tend to think about the next 12 months and 24 months, but if you broaden and go, well, most of these portfolios that I'm managing are going to be there for decades, and you're not exposed. I mean, 8% on a credit issue sounds good, but if you're not exposed to the next Googles and Ubers and
the big
all that,
waves,
you're really missing out. So you got to have both, right?
I think it's a great way to look at it, and because I do think that we are typically short-sighted in investing. What's happening in the next 6 months, 12 months, like you said, 2 years. But that's just it. It's not like these portfolios go away in 2 years. They're not over. They need to last 10, 20, 30 years, and then maybe past that. So anyway, a great perspective to have.
Yeah.
And I also like what you're saying, just as far as about what we're doing, all the reshoring that's happening, all the manufacturing that's happening, especially in Texas, right, where we're at, in Austin right now, but really kind of across the state. I mean, it's a good time to be here. It's one of the reasons we focus on real estate. But yeah, I think the stocks behind these big companies that are going to be making massive changes in the way we live over the next 5, 10, 15 years. It's a big deal.
Yeah, if anyone tells you they can have any predictive accuracy about what that's going to look like. They don't. I mean, again, go back to. I remember I was in in my MBA program. That was my first day. I walk in the library. They have a computer terminal, and I saw the web for the first time. It's 1995, I guess. And I, went to Yahoo and looked up something about the Houston Rockets because they were in the playoffs at the time, right?
Right, had to make good use of it.
Yeah, right.
Yeah.
And no clue that we'd be carrying around iPhones and we just got back from a trip and used Uber all over the world and all these things that have come out of the internet and that technology. I mean, the world has changed completely since we were in school, right?
Right.
Well, this next wave is, I mean, it's just accelerating on all fronts. Like the computing power, the applications of AI in every sector. I mean, people think of AI like, oh, Chat GPT is going to do great, and Microsoft is going to do great, but HEB may do great because they're using AI to improve their efficiencies, right? I mean,
It's true. I was on a Zoom call the other day and was there with a couple participants, and then there was an AI little bot that was there taking notes for everybody, and then producing a nice summary on the back side of that. And I thought, wow, that's nice. I'll actually remember what we talked about and what the action items were, and not having to have someone else doing that. And that's just a small little piece of what's going to be going on. It's really, I think, when you think about what can change, in some ways, it's almost a little overwhelming about
it is
what can happen.
Yeah.
But that's where we're going, and so better to be a part of it than on the complete outside of it.
Yeah, I agree, and but thinking just from the perspective of investing, this is kind of what I'm, my view is. This is why we have diversified portfolios. This is why I love real estate. You've got a real asset, you've got tax advantages, you've got all the beautiful things about real estate. I've got fixed income that is now attractive because I can make good rate of return above inflation. But I've also got to have those pockets of growth. If I diversified portfolio in public and private equities and venture capital. If you've got enough of a portfolio to dip your toe into venture capital, it's like these are fantastic things to be a part of, and it's just a really interesting way to invest. And I think like I said, those asset classes, venture capital. We've talked about that for a second. That's a world where that's kind of one of the last frontiers of alternative asset classes that is accessible in a way that sort of makes sense for the average investor. If you're not, Sequoia or something like that, right? But it's coming, and that's where there's just so much stuff happening all around the world, and literally 5 or 10 people can create a multi-billion-dollar entity in the modern world. You don't need,
pretty amazing.
Yeah, you don't need a massive investment of capital and all this kind of stuff. So that company may never go public.
Right, because it'll get scooped up well before it does. Yeah,
but you can still find your way to invest in those opportunities. Now, again, it's a little tricky. It takes a larger portfolio to sort of dedicate a piece to venture capital. But again, it's improving. It used to be you kind of have to know all the right people and all that kind of stuff, or someone in town has a single thing that they're starting up, so you throw some money there, and that's not a great way to invest,
it's
right?
kind of gambling a little bit there.
Yeah. I mean, it's if you're taking a significant piece of your portfolio, It's not a great. If you're just helping a friend, that's fine. But now venture, I mean, it's just that's what that's changed in the capital markets. When I was growing up in this industry, it was small companies were sort of the highest highest growth oriented. These small companies that would grow to large companies. That's kind of almost gone, because by the time these Silicon Valley tech startups go public, they're large cap companies.
Yeah, they come out of the gate as a large
jump
cap.
into the S&P 500 in the middle of them somewhere. Right?
Yeah, that's right.
So you got to change the way you invest, right? So
I appreciate that you can guide people through that, because I do think that Granted, you have to have some size, right, in your portfolio and be able to plan around that. But having access to those type of investments and something that is diversified, so you're not missing out on something, but at the same time you're well balanced and
Yeah.
really kind of controlling risk and setting up your clients for the long term. And that's a really big deal. That changes their lives. It changes the lives that come after them. And I think it just shows that you guys are being really great stewards of really people's lives, not just their capital, not
Yeah.
just their money.
Yeah. I mean, things change. Things change a lot. Even the fund that the funds that you guys run. I mean, that was 20 years ago, 25 years ago. I mean, you just couldn't. The average investor couldn't access that. Like, wait a second, this is a great asset class. It's got great risk and return profile. Secured, all that stuff. I'm like, yeah, but you can't do it. Well, now you can.
Now you
Right? I
can.
mean, it just keeps improving, and that's good.
It's been nice for us, and the big change I think that's happened is as you've had more of these private investments come out. We've always had what I would say is a really good process and generated a good yield for the amount of risk that we're assuming, but now people are comfortable with it. Which for the first few years of the fund, it was like, what are you guys doing, and how are you doing it, and this is
Yeah.
really a black box. And we've always been saying we're just lending money on real estate like anyone else. There's no magic here.
Yeah.
There's nothing that's scary about it. But now it really is a lot easier to have a conversation with someone, an investor, saying this is a private investment. Yes, it's for accredited investors. This is the profile, and this is how it works. And I think there is just better market acceptance, and I think people are looking for ways to diversify out of those super traditional portfolios where it's the same as everybody else. And I think that you, with what you're doing, providing access to great investments for your clients, I think it's super valuable. It's a huge deal. Like I said, it changes lives and really maximizes what those business owners and everyone else that you serve really have and what they can do. And I think that's what it's for me. It's maximizing, providing freedom, providing choices and peace of mind, having really great planning and someone that's always in your corner. That's a really big deal.
Yeah.
Really big
Yeah.
deal. So, Matt, tell people how they can get a hold of you. What's the best way to do it if they want to give you a call or just kind of talk shop with you?
Yeah, I mean, ARK is ARK Financial. Just website, pretty easy access, pretty easy to find me. You can find me on LinkedIn. Matt Goff, ARK Financial, pretty easy to find.
And if you have people that are interested in the academy, which we talked about, which sounds like a great program, I need to sign up myself. What is that also through the website, or is that giving a call into the office? What does that look like?
Yeah, so the academy right now again is kind of focused into a specific industry association. So we've set it up where we are working with an industry. This is this auto shop industry called Shop Fix. So there's this entrepreneur out in Nashville named Aaron Stokes who created this organization to help auto shop owners just run an efficient shop. It's a great business.
Mm.
You can imagine a lot of folks who are in the auto shop business don't have a business financial background.
Sure.
They have an auto shop background. Well,
That's where we all start, right?
Yeah,
When
Aaron
business
comes
somewhere.
in. Aaron comes in and teaches them how to run their shop efficiently, how to move cars, efficiently through a system, how to set up the systems, and all that kind of stuff. So that's this group. They're called Shop Fix. So we have our first iteration of the academy, and he's got thousands of members, is set up for that group. So we not only are doing all the coaching that we talked about related to finance, but it's tailored specifically to their industry and their set of things. They always own the real estate, and we kind of understand the metrics that drive a shop. How quickly a car gets through the process, all that kind of stuff. So we are actively building to expand that academy to others, but yeah, I mean, any questions about kind of the stuff that we're doing there, just come. You can kind of come through me. Again, find me on LinkedIn or the web. So
Great. Matt, thanks for being here. Ken, I really enjoyed the
Yeah, a lot of
conversation,
fun.
all the different aspects. Great time today. We're also going to have Matt's contact information in the description, also on our website. Matt's just a great resource, as you can tell. Had a great time with you today, Matt. Thanks thank you to ARK and everyone over there for letting us hang out for a few hours on a
It
Friday.
was fun.
We look forward to seeing you on the next Under the Hood podcast. If you have any questions, please give us a call at the office or hit us at investors@stallioncap.com. Look forward to seeing you on the next episode. Take care.